All right, we see that. A lease is a contract. A lease is a contract. A lease is a contract between two parties. A lease is a contract between two parties. A lease is a contract between two parties. Where one party, known as the lessor, where one party known as the lessor, in bracket owner. Yeah, where one party known as the lessor stroke owner gives another party known as the lessee, gives another party known as lessee, gives another party known as the lessee the right to use the asset, the right to use the asset, the right to use the asset, and enjoy the benefits, and enjoy the benefits, and enjoy the benefits, and enjoy the benefits, and enjoy the benefits associated with the utilization of the asset, associated with the utilization of the assets. Yeah, and enjoy the benefit associated with the utilization of the asset. Full stop. Then where to see that? See that? In order for such contracts to exist, in order for such contracts to exist, in order for such contracts to exist, comma, the user of the asset, the user of the asset needs to have the rights to, the user of the asset needs to have the rights, the user of the asset needs to have the rights to, semicolon, needs to have the rights to, semicolon, number one, obtain substantially all the economic benefits, obtain substantially all the economic benefits, obtain substantially all the economic benefits from the use of the asset, from the use of the asset. Number two, the right to direct, the use of the asset, the right to direct the use of the asset, the right to direct the use of assets. Yeah, so that means this is a contract between two parties, where one party known as the lessor, the owner, gives another party the right to use the asset and enjoy all the benefits, to transfer even all the risk. Yeah, so now let's look at type of leases. Types of leases. And we have 4 types of leases. Number one is lease. Number 2, we have finance or capital lease. Number 3, we have leverage lease. And number 4, we have what we call sale and leaseback. This. Yeah, those are the 4 types of lease. Now, the difference between the 4 is that now an operating lease is this one is a short-term lease. Then finance lease, this one is a long-term lease. Long-term in that the lease period is at least equal to 75% of the asset economic life. Let's assume that the economic life of the asset was 5 years or 6 years, and then you lease it for 5 years. So that means in this case, the lease period is more than 75% of the economic life. So that's what we call a finance lease. Then we have a leverage lease. Now, leverage is the use of the debt. Now, leverage lease is where the asset under lease has some financial obligation outstanding. Assume that here we have JM who owns a given machine. Let's assume an excavator. And then you lease it to another party. But in this case, for me to acquire this excavator, I had taken a loan maybe from a bank worth 10 million. So here we have the lessor, that's the owner. Here we have another party, the lessee. So that means I have leased this asset to another party, lessee. So that means the lessee will be paying what we call the lease rental to me. And then I use that lease rental to pay for the debt I used to acquire that asset. That's what we call a leverage lease. Is a lease whereby the asset under lease has some financial obligation outstanding. Another characteristic is that for leverage lease, it has 3 parties: the lessor, the lessee, and the financier or the bank. Good. Then number 4, we have the sale and leaseback lease. Now, sale and leaseback lease. Take the same scenario of this asset. I own an asset, then I lease to another party. And then during the lease period, I decided to sell that asset to another party, or maybe the same party. I sell it to the other party, and then I lease it back from that party. That's what we call the sale and leaseback. Good. So now let's start with number 1, operating risk. Operating risk. Operating risk. See that? This is a short-term risk. This is a short-term risk. This is a short-term lease. Full stop. It has the following characteristic. It has the following characteristic. It has the following characteristics. It has the following characteristics. Number one, the lease period is very short. The lease period is very short. The lease period is very short. Relative to the economic life of the asset. Relative to the economic life of the asset. Relative to economic life of the asset. Number two, the lease contract can be cancelled. The lease contract can be cancelled by either party. The lease contract can be cancelled. The lease contract can be cancelled by either party. Can be cancelled by either party. Anytime before the end of the lease period. Anytime before the end of the lease period. Anytime before the end of lease period. Anytime before the end of the lease period. Number three, the owner stroke lessor. The owner stroke lessor incurs operating and maintenance cost. Incurs operating and maintenance cost of the asset. The owner stroke lessor incurs operating and maintenance cost of the asset. Number four, the lessee is not given an option. The lessee is not given an option to buy the asset. The lessee is not given an option to buy the asset. It's not given an option to buy the asset at the end of lease period. At the end of lease period. At the end of lease period. Good. Number two, finance stroke capital lease. Finance stroke capital risk. Let me say that. These are long-term lease. These are long-term lease. Whose lease period is almost equal. Whose lease period is almost equal. Whose lease period is almost equal to the economic life of the asset. Whose lease period is almost equal to the economic life of the asset. Good. It has the following characteristics. It has the following characteristics. It has the following characteristics. Number one, the risk period is at least 75%. The risk period is at least 75% of the asset economic life. At least 75% of the asset economic life. Number two, the risk contract cannot be cancelled. The risk contract cannot be cancelled by either party. The risk contract cannot be cancelled. The risk contract cannot be cancelled by either party. Before lease period matures. Before the lease period matures. Another one. The receipt in cash, all the operating, the receipt in cash, all the operating and maintenance cost, all the operating and maintenance cost. And then number four, the receipt is given an option to buy the asset. The receipt is given an option to buy the asset. The receipt is given an option to buy the asset at the end of lease period. At the end of lease period. At the end of lease period. Those are some of the characteristics of a finance risk. Then you write an NB. The above characteristic for operating risk and finance risk. The above characteristic of operating and finance risk are also notable differences. Between the two. Good. Number three, leverage risk. Leverage risk. Let us see that. This is a risk whereby the asset under consideration, has some financial obligation outstanding. Has some financial obligations outstanding. Number four, lastly, sale and leaseback risk. Sale and leaseback risk. Let me see that. These are risks whereby the lessor sells the asset under risk, to another party, and then lease it back. Those are the four types of risks. Now let's look at accounting for risks. We start by receipt. Accounting for leases by receipt. Accounting for leases by receipt. We look at initial recognition. Initial recognition. Let me say that. At the commencement date, in bracket, open the bracket. The date there is so, makes the underlying asset. The date there is so makes the underlying asset available for use by the receipt. The date there is so makes the underlying asset available for use by the receipt, close the bracket. We have said that the date there is so makes the underlying asset available for use by the receipt, close the bracket. The receipt recognizes, semicolon, A, lease liability, and B, a right of use asset. Yeah, lease liability and right of use asset. Now let's start with the lease liability. Now, first of all, let me explain this. Now, you see, in this case, if you have an asset and then you lease it to another party, now how do you account for it as another party? Now, we say that number one, as the receipt, for example, if you lease a machine for 3 years. Now, that means for these 3 years, you are the one now to enjoy the benefits associated by that asset. So an asset brings in some benefits, some future economic benefits. So that means you as the receipt, you need to account for that asset, number one, as an asset. Why? Because you are the one enjoying the benefit. So that's what you show as right of use asset. But on the other hand, this is not your asset. It belongs to another party of which you made a commitment. You'll be paying what we call the lease rental. So in short, there is something you'll be paying. So that one makes it a liability. So for that liability, you show it as a lease liability. So you show that asset as an asset. I mean that item as an asset because you are the one enjoying the benefits. And then remember, this asset has some financial obligation of standing because you'll be paying the lease rental. Therefore, you show as a liability. So we start with the lease liability. We have to say that the lease liability is initially measured. There is liability is initially measured. The lease liability is initially measured at the present value. Initially measured at the present value of lease payment, not paid at the commencement date. The present value of lease payment not paid at the commencement date, discounted at the interest rate, at the interest rate of the lease asset. Discounted at the interest rate of the asset. Good. In bracket. Now, when you have the lease liability, can you write in bracket? Is the same as fair value. Now, when we have the lease liability, just write in bracket is the same as fair value. Then now let's look at the right of use asset. So let me say that. The right of use asset is initially measured. The right of use asset is initially measured as follows, semicolon, Roman 1, lease liability, Then number 2, initial direct cost incurred, and then number 3, payment made before lease commencement date. Payment made before lease commencement date. Payment made before the lease commencement date. Yeah, that's what we call the payment in advance. Payment in advance. Yeah, that's what we call, we incorporate the right of use asset. Now, this is what I mean. That to get the right of use asset, you will take the lease obligation, then you add initial direct cost incurred, and then you add any payment made in advance. Good. Now, can you show that? Show that. Now, once you recognize the right of use asset, you see this one, you show it as part of the non-current asset. And being an asset or a machine, you need to depreciate this machine. Now, the question is, how do you depreciate? You have to use the cost model of IAS 16, that's PPE, whereby when depreciating this asset or you assess for impairment or for depreciation, you need to depreciate based on the area of or ROA of. Based on the ROA of. Number 1 is the lease period or the asset economic life. Now, assuming that the asset economic life was for 5 years, but you lease the asset for 4 years. Now, once you get the amount to capitalize, that's the right of use asset. So how do you depreciate? You depreciate based on the ROA of the two, the lease period and the economic life of the asset. So in this case, you will depreciate the right of use asset for 4 years. Then you write to say that, write another paragraph, The right of use asset, is normally measured subsequently. The right of use asset is normally measured subsequently at cost. Less accumulated depreciation, and impairment losses. Measured subsequently at cost, less accumulated depreciation and impairment loss, in accordance with the cost model, of IAS, 16. IAS 16 in bracket PPE. Good. Then we have to see that the right of use asset is depreciated. The right of use asset is depreciated from the commencement date. It's normally depreciated, or the right of use asset is depreciated from the commencement date, to the area of end of useful life, or end of lease term. End of lease term. As simple as that. So I want us to do an illustration. Handout page 4. Handout page 4, question 1. Handout question 1, page 4. Now, page 4, to that, Royal Contractors Limited owns an item of plant used for construction with a carrying value of 14 million as at that 1st of December 2015. So the carrying value of this asset is 14 million. The firm won a construction contract and decided to sell and lease back the machine on that date under the following condition. So they decided to sell this asset and then they lease it back under the following condition. Number 1, selling price 40 million. So how much was the carrying amount? 14 million. But we sold it at how much? 40. So number 1, there was a disposal gain. $40 million, you minus the carrying amount of 14 million, that means there was a gain of 26 million. Yeah, you sold it and then you lease it back. So you're told that point number 1, selling price 40 million. This was also the fair value of the brand. So that means when you lease the asset, you lease it at its fair value of 40 million. And then you're told that lease rentals payable annually in arrears amounted to 15,521,200 payable annually. Lease duration for the machine was 3 years. So you lease it for 3 years. The economic life of the machine was also 3 years. So this one is a finance lease because the lease period is equal is the same as the economic life. Good. The interest, the implicit interest rate was 8% annually required. Financial statement extract for the 3 years. So how do we account for this? So number 1, we see that if we sold and then we lease it back, so that means we have the receipt. And you see that as a receipt, how do you recognize this asset? You need to recognize 2 items. Number 1 is the right of use asset, and number 2 is the lease obligation. And how do we get the lease obligation? Or lease liability. Now, lease liability is the same as fair value. I go back to your notes. What is lease liability? So that what is lease liability? What is lease liability? Is it like what? Is that? Aya, soma kenye mliandika. Wacha kuniangalia hapa. Is measured at present value. So in short, the lease liability, or what you call the amortized cost or the fair value, is the present value of lease rentals not paid at the commencement. So in this case, we agreed we'll be paying the lease contract is for how many years? 3. Then how much will we be paying each year? 15,521,200. Now the question is, we'll be paying 15,521,200 each year for the next 3 years. So it's an annuity. Now the present value of that annuity is what you call now the lease liability. So you'll take 15,521,200, then you discount present value interest factor of an annuity. The cost of capital, we are told it's 8% for the next 3 years. So it will be 15,521,200, 8% for 3 years. So it's 1 minus 1 plus R, which is 0.08 raised power negative n, divided by 0.08. That's the formula of getting an annuity. What do you get? Then multiply by 15,521,200. Multiply by this. Give me the fair value. That's 9. It's approximately equal to 40 million, right? Yes. And that's what you are given. If you're not given, that's how you compute. Can we go back to the first point? The first point, we are told that selling price 40 million. This was also the fair value of the plant. Yeah, we see that the lease liability is the same as the fair value. So if you're not given, that's how you compute that. It's equivalent to 40. Then the next step, you also need to recognize. Now, this is the liability. This is what you amortize. What about the right of use asset? To capitalize now, right of use asset. So that to get the right of use asset, you'll take the lease liability, which is 40 million. You add initial direct cost. We are not given, so that is 0. You also add the payment made at the commencement. Now that one only applies when the lease rentals are payable in advance. So payment made in advance. It's also 0 because in this case we are paying in arrears. So you still get 40. So the lease liability will be the same as a right of use asset. Then for the right of use asset is that you need to depreciate. So depreciation per annum is that you depreciate based on the row of economic life or the lease period, of which were the same. They were 3 years. So you'll take 40 million. You depreciate for the next 3 years. 40 divided by 3, you get? Three. So how do you account for this? So we need to amortize the liability. So you come up with the lease amortization schedule. Lease amortization schedule, you have the period, which we have is 2016, 2017, 2018 was for 3 years. And then we have the balance brought down. Interest at the rate of 8%. Then there is payments. Now the payment comprises of 2 elements. Number one is the principal, the other one is the interest. So we need to determine the principal. And then you get the balance carried down. How much the balance brought down? So we are amortizing the liability. So the fair value was 40 million. Interest rate is at 8%. 8% of 40, that is 3.2. 3.2. Now the payment is an annuity, is the same. So you agree that each year you'll be paying an amount of 15,521,200. 15,521,200. 15,521,200. It's an annuity. Then I've said that the payment comprises of the interest and the principal. Now you paid 15,521,200, of which the interest was 3.2. So how much was the principal? So to get the principal, you take the payments, you minus the interest. So you can call it A, this one B, this one C, so D. So to get D, you take C minus B. You can call it E. So to get E, so what do you get? 12,3,200. Now you want to get the balance carried down. Now the balance brought down was 40 million. Then you deduct the payment of the principal payment. So you take the balance brought down, you minus the principal. So to get E, you take A minus D. How much will be the balance carried down? 27? 800. The balance carried down becomes the opening balance. So we'll have 27,678,800. 8% of that is how much? 22,14,304. Good. Now we get the principal. To get the principal, you take the payments, you minus the interest for the period. 896. Good. So to get the balance carried down, you take the balance brought down, you deduct the principal for the period. Sorry? 904. So the balance carried down becomes the opening balance. So you have 14,371,904. Interest at 8%. 752. So you get the principal. You take the payment, you minus the interest. $14,371. 448. Now let's get the balance carried down. You take the balance brought down, you minus the principal. You get 456, so equated to 0. Good. That's how you're supposed to amortize the debt. Now the question was, can I go back to the required? What are you supposed to compute? Yeah, financial statement extract. Now, how do we account for this risk in the financial statement? So start with the income statement extract. So we dispose this asset at a gain. We need to recognize this disposal gain. So to the income, we have disposal gain, which was an amount of 26 million. Then we have the expenses. Now for the expenses, we have two expenses here. One is the interest. The other one is depreciation. And these are the interest expense. So 2016, it's an amount of 3.2. 2017, we have an amount of 2214, 304. And then 2018, we have an amount of 1149, 752. Then you also depreciate the assets, and depreciation per annum was 13 million, 3 recurring. Then what about the statement of financial position extract? Now to the statement of financial position extract, so you have 2016, 2017, and 2018. Number one, you capitalize the asset. So to the non-current asset, we'll have right of use asset. How much was the right of use asset? It was 40, correct. You take 40, but we say that we need to depreciate this asset. So you deduct that this was initial recognition, which was 40, the right of use asset. Then during the year, we charge depreciation of 13 million. So you minus depreciation, 13, 333, 333. And you get 20. Then 2017, you take 26, 667, you minus depreciation for the second year. How much will be the balance? Then you take 13, you minus depreciation for the third year, you get 0. So that means by then the asset will have been fully depreciated. Then this asset does not belong to you. So we'll have a liability. And for liability, we have the non-current liability as well as the current liability. So here we have a lease obligation. So here you have a lease obligation. Now, when you're paying in arrears, the lease obligation for the non-current liability, you take the balance carried down. Then for the current liability, you'll take the principal. What's the difference between a current liability and a non-current liability? What's the difference between the two? Okay, what's a current liability? Short term. Short term is relative. If you pay your school fees in 1 year, that's a wrong period. If you pay within 1 month, a short period. So short term or long term is relative. So use the accounting term. Current liability, the liability payable within 1 year. That's very wrong. If you pay within 1 year, now that one does not become a liability. Are you together? Because we present the financial statement at the end of the year. So what we pay within that 1 year is no longer a liability. So hakuna kitu kama hiyo. Correct. As simple as that. A current liability is amount payable within the next one financial year. What you pay within the year, that one does not become a liability. Because liability is what's outstanding at the end of the financial year, which you have not paid. So a current one is what you expect to pay within the next one financial year. Non-current is the one we are not able to pay within the next one financial year. Yeah, that means may take more than 1 year. So that means for you to get the liability for 2016, you take for 2017. It's all about the next one financial year. So this is what I mean in this case. So for the non-current liability, you take the balance carried down. For 2016, the liability is for 2017. For 2017, you take for 2018 because they're all about the next one financial year. So in this case, for 2016, you take for 2017, you take the balance carried down. You have an amount of 14,371,904 dash. For the current liability, you take the principal. The principal, here you take the principal. So it's a liability. So for 2016, you take for 2017 in amount of 13,306,896. For 2017, you take for 2018, it will be an amount of 14,371,448 dash. What does that mean? Now listen here. At the end of the first financial year, 2016, this was the balance. At the end of the next financial year, the balance is how much? 14. Can you see there is a reduction? A reduction by how much? Give me the reduction. You take 26,678, 800, you minus this. You get? Hey, unachukua una minus hii. Tufanye haraka haraka. You get an amount of that? You see now, from first year to the end of the next financial year, there is a reduction by 13,306. So within 1 year, what you're able to pay within that 1 year. So the difference imekuja 13,306. That one is what we call a current liability. What you're able to pay within the next one financial year. And that's what we had here. 13,306. Higher. What is the non-current liability? What you are not able to pay within the next one financial year. So the balance at the beginning of the year was at the end of the year was 27,678, 800. We paid 13,306, 896. So the balance was how much? 40. So that means 14 we are not able to settle within one financial year, and that one becomes a non-current liability. 14,371,904. You can copy. December 2022, question 1B. Now let's start with part A of the question. Now, 1A, you are to that. In the context of IAS 16, property, plant, and equipment, 1. Explain how the initial cost of property, plant, and equipment should be measured and treatment of subsequent expenditure. That's very simple. PPE. The initial cost of PPE, if you buy an item of motor vehicle at 4 million, how do you treat that? That's what they want. And the treatment of subsequent expenditure. So initial cost, you need to capitalize. And how do you measure it? You measure it at fair value or the transaction cost. If you incurred 4 million, you just take that 4 million, of which that's the fair value. So the initial cost is measured at fair value and should be capitalized. Capitalized, that means it will be taken to the balance sheet as part of the non-current asset. Then they also ask about the subsequent expenditure. Now, subsequent expenditure, it depends whether it's a capital expenditure, like an overhaul cost of changing an engine. So in case of capital expenditure, you capitalize. Normal expenses, you expense, as simple as that. Like maintenance costs, you just need to expense them. That's what the examiner was asking. It was not that hard. Number 2, describe the requirement regarding to the revaluation of non-current assets. Revaluation, the treatment of surpluses and deficits. That's the revaluation gain, revaluation loss. So first of all, don't cut me short. Wacha nimalize kwanza. And revaluation on gain on losses on disposal. 6 marks. Hiyo swali imeuliza mambo 3. To get 6 marks, you just need to state. Okay, can you read the question to understand first? Yeah, describe the requirement regarding to the revaluation of non-current assets. The treatment of surpluses and deficits. How do you treat revaluation gain and losses? You take them to the revaluation reserves, or okay, and you take it to other comprehensive income. Yeah, revaluation of PP should be recognized under other comprehensive income. Then you take it as part of revaluation reserve, whether it's a gain, whether it's a loss. Also, they want the gain or losses on disposal. How do you treat a gain or loss on disposal? To other, in short, you take it to the P&L. That is it. Like the one we have done. It was a disposal gain, take it to the income statement as an income. If it's a loss, you still take it to the P&L as an expense. As simple as that. And you get your 10 marks. Number B of the question. Vox Limited leased a factory to Tena Limited with effect from 1st of July 2022. The lease is for 4 years at an annual lease rental of 4 million. Annual lease of 4 million, payable annually in arrears. So we pay them in arrears, 4 million each year for 4 years. The lease contract provides the lease shall be responsible for the insurance and maintenance of the factory during the lease term. The implicit rate of interest in the lease is 15% per annum. How do you account for it? Now let's be here. First of all, you need to recognize a lease liability. And you see that lease liability is the present value of lease rentals not paid at the commencement. So the contract is for 4 years. How much will be paying each year? So you'll take 4 million, you discount. Present value interest factor of an annuity. The cost of capital is 15% for the next 4 years. So you'll take 4 million times 1 minus 1 plus R, 0.15, raised power negative 4, 0.15. So give me that. How much will be the lease liability? Sorry? Cannot be 11 million. Or it's 11 million? Yeah. Present 4 million for the next 4 years. Okay, anyway. 11 million. 498. 19, eh? 930? 930. 13, eh? 13, like that. What about the lease? Our right of use asset. It will be the same. Eh? To get the right of use asset, you say that you take the lease liability, which is 11, 419, 913. You add the initial direct cost, which was 0. Then you also add the payment in advance. This one we are paying in arrears. Eh? So it remains to be the same. 11, 419, 913. Then we depreciate the right of use assets. So depreciation, you take 11, 41, 9913. You depreciate for how many years? For 4 years. Good. So how much will be depreciation per annum? Sorry? 970? 978. From there, we amortize. So we come up with lease amortization schedule. So we have the period. Then we have the balance brought down. Interest at 15%. Payment. Principal. And then we have the balance carried down. And then it's for 4 years, commencing on 1st of July 2022. So if the financial year starts on 1st of July 2022, that financial will end in 2023, 2024, 2025, 2026. How much is the balance brought down? Good. And we are amortizing the liability, not the asset. 11, 419, 913. Interest at 15% will be how much? Sorry? 1712? Sorry? 87, eh? Then the payment is constant. How much is the payment? 4 million each year. And they say that the payment comprises of 2 elements. Yeah, the payment comprises of the interest and the principal. Now we paid them 4 million, of which the interest was 1712. So how much was the principal? 2287? Sorry? 030. 030. Now give me the balance carried down. You take the balance brought down, you minus the principal. Sorry, 91? 900. And then the balance carried down becomes the opening balance for the next period. So the balance carried down becomes the opening balance. 91, that's 2,900. 15% of that is how much? 1369. Sorry? 935. You take 4 million. First of all, you minus the interest to determine the principal. 20? 065. So to get the balance carried down, you take the balance brought down, you deduct the principal. Deduct the principal. 6502. 835. The balance carried down becomes the opening balance. You'll have 6502. 835. 15% of that is how much? 975. 425. 4 million minus that one, you get that. That's 24. 575. So to get the balance carried down, you take the balance brought down, you deduct the principal. That 478 too. The balance carried down becomes the opening balance, so you have 34, 78 to 60. 15% of that is how much? Sorry? 739. 4 million minus the answer, get that in? 261. Then you take the balance brought down, you minus, getting a difference of 1, right? Yes. Good. So how do you account for this? So what do you take to the income statement? What do you take to the balance sheet? So income statement extract. So you have here 2013, 2014, 2015, and 2016. So here you have the expenses. For the expenses, we have the interest expense. And then we have depreciation. And for the interest expense, we have 1712, 987. We have 1369, 935, 97, 54, 25. There we have it 521, 739. Now depreciation was 2854, 978, 2854, 978, 2854, 978, 2854, 978. What about the balance sheet? Um, 2025 and 2016. 2026. Yeah. So we capitalize the assets. So you have the non-current asset. Or you have the right of use asset. We have the right of use asset is 11, 419, 913. Then you raise depreciation. Depreciation for the first year was an amount of 2854, 978. How much will be the net book value? The current amount? 95, 85, 64. $935. Then 2024, you take this, you minus depreciation for the second year. Five 570 9957. Then you minus 2854. And then we have the non-current liabilities. And then we have the current liability. So here we have a lease obligation. Now you see that for the non-current liability, what do we take? Balance carried down goods. Also you have lease obligation. For the current liability, you see that you take the principal. Good. So you start with the balance carried down. Now for 2023, you take for 2024. So here we'll have an amount of 65,028.35. Here you have 34,78,260 dash dash. For the current liability, we take the principal. For 2023, you take for 2024. So here we have an amount of 26,30,065. 24, 575. We have 34,78, 261 dash. So meanwhile, you can copy. That's something. Lease accounting by lease accounting. Now by the lessor. Lease accounting by the lessor. In bracket owner. In bracket owner. Now let's go back to our question. The question I've been doing, December 2022. Question 1B. The same question. We have that Vox Limited leased a factory from Tenor Limited. So that means Vox is the one who leased a factory to Tenor. So who is Vox? So is the owner, right? And Tiana Limited, that one becomes the lessee. Now let's go to the required. Demonstrate with suitable calculation the accounting treatment of the above lease transaction in the financial statement of Vox Limited. That's the owner for the year ended 30th of June 2023, 2024, 25, and 2026. So as a result, how do you account for this? Now, as a result, number one, we say that you are not the one using the asset. You have leased the asset to another party to use for the next 4 years. So that means to you, this one is what we call an investment property. You are holding this asset to earn rentals. You are not using. If you are not using, it is not to depreciate the asset. Now, the lessee is the one to depreciate the asset. So how do you account for it? Now, when you're determining the lease liability for in case of Ifrs, now this one is the owner. Now, for the owner, initially we recognize what we call initial lease investment. Now, this one will be equivalent on how to determine the lease obligation. The present value, now this one will be equivalent to present value of receipts expected over the lease period. Yeah, which is equivalent to the lease obligation. The present value, in this case, you are not paying, you are the one receiving, but you are receiving the same amount. So that's how you determine that. So you take the initial lease investment is the present value of receipts expected over the lease period. So in this case, you don't recognize the right of use asset. You are not the one using. If you're not the one using, so that means there is no element of right of use asset, and therefore you also don't depreciate the asset. Then you amortize. Amortization schedule remains to be the same. You have the period balance brought down. Now, instead of interest expense, now this one will be interest income. You are the owner, you are the one receiving this interest. So here you have interest income. Instead of payment, you are the one receiving 4 million each year. So it will be what? Receipt. Principal does not change and the balance carried down. Now, the other difference now will come to the statement of financial, I mean the extract of the financial statement, no depreciation. Now, instead of expenses, now you show an income. So under the income, we'll have the interest income. Nothing will change. Then to the statement of financial position, there is no right of use the asset, but you show some assets here. So we have an current asset. We have lease investment, as well as we have the current asset. Also for the current asset, you have lease investment. So to the other party, to the non-current liability, the lease investment, they were taking the balance carried down. The same here. You take the balance carried down. For the other party, that's the receipt. The current liability, they were taking the principal. Also here for the current asset, you take the principal. So it's the same. Now here you have amortized the asset. So for 2023, you take for 2024. So this one will be an amount of 6502, 835, 34, 78 to 60 dash dash. For the current asset, you take the principal. In short, what we're taking, we are doing. What the receipt had shown as an uncurrent liability, you show it here as an uncurrent asset. What the receipt showed as a current liability, show it as a current asset. So here you take the principal, 26, 30, 065. We have 30, 24, 575, 347, 82, 61 dash. Can copy. Now this is what the question now wanted. You are counting for the other part. Sorry? No, you don't impair the asset. No, you are not impairing. You are not impairing. This one is an investment property. You are not the one using. Because the benefit you expect to receive, they are constant. You agreed 4 million. Yeah, regardless of the economy, the other party is the one who is supposed to impair the asset. Now let's look at now when you pay the leases in advance. Now let's do handout question 2. A company entered into a 4-year lease commencing on 1st of January 2018 and intended to use the asset for 4 years. The term are for payments of 50,000 shillings commencing on 1st of January 2018. You see, they entered into contract on 1st of January 2018. Now let's see that again. A company entered into a 4-year lease commencing on 1st of January 2018 and intend to use the asset for 4 years. The term are for payments of 50,000 commencing on 1st of January 2018. So that means in this case, you are paying in advance. You're not paying in arrears. And annually thereafter. The interest rate implicit in the lease is 7.5%, and the present value of the lease payment not paid at 1st of January 2018, that is the 3 payment of 50,000, discounted at that rate is 130,026. Legal costs to set up the lease incurred by the company were 402. That's the initial direct cost required. Show the lease liability from 1st of January 2018 to that 1st of December 2021 and explain the treatment of the right of use in the asset. So in this case, we are paying, or we are counting by the receipt, not the lessor, where we are making the payment at the commencement. So how do we get the lease liability? Now, to get the lease liability of the fair value, we see that this one is equivalent to the present value of the payment not paid at the commencement. Now, the lease period is for 4 years. How much are you paying each year? 50. So therefore, you'll take 50,000. You discount present value interest factor of an annuity. How much is the cost of capital? 7.5 for how many years? For 3 years. Good. So what do you get? So it will be 50 times 1 minus 1 plus R, 0.075 raised power negative 3 divided by 0.075. Is that 3 years or 4 years? 3 years, good. $130? 0.26. Yeah, it's 3 years. You see, the risk was for 4 years. We pay 50 year 1, 50 year 2, 50 year 3, 50 year 4. Now I want to determine the liability at the commencement. Now at the commencement, remember, you are paying in advance. So before you use the asset, you already paid a deposit of 50 at the commencement. So that means the liability is what we expect to pay for the next 3 years. Remember, I said that lease liability is the present value of lease payment not paid at the commencement. So in this case, at the commencement, you already paid 50. So the balance will be for the remaining 3 years. Then we need to get the right of use asset. And the right of use asset, we say that you take the lease liability, which is an amount of 130,026. Then we say that we also add initial direct cost. How much was the initial direct cost? Yeah, the incurred 402. Also, you add the payment made in advance. How much did we pay in advance? Yeah, we paid 50. So how much will be the total? 428, right? 180, 428. Now that will be the right of use asset. Then we depreciate. So depreciation per annum will be 184.28. You depreciate for the next 4 years. 90, that's 45. Sorry? 907. 107. Good. Then let's amortize the asset. You come up with amortization schedule. Now, when amortizing and the payment you are made in advance, the amortization schedule format will change. So here you have the period. Here we list on 1st of January 2018. So we have 2018, 2019, 2020, 2021. So you'll have the balance brought down. Then you are paying it at the commencement. So you start by paying. And that's how you get the balance due. And then you pay the interest based on the balance due at the rate of 7.5%. And that's how you get the balance carried down. So when you're paying in advance, that's the format. So how much the balance brought down? Yeah, it's an amount of 130. Correct. We are amortizing the liability, not the asset. So you take the lease liability, which is an amount of 130,026. Payment. How much are you paying? 0. This is the first year, right? So there is obligation at the beginning had already paid the fee? The 50. In short, the payment you see that is for the remaining 3 years. So the first period we are not paid. So we are not going to pay because we have already paid. This 130, we did not count this because we had already paid in advance. So the balance due will be 130,026. Then interest of 7.5. Sorry? 97? 52. So this was the balance due after paying the payment. Then it accrued an interest of 97.52. How much will be the balance carried down? So you take 130, you add the interest accrued for the period. So how much will the net liability? 139? 770? 770. The balance carried down becomes the opening balance. So we have 139,778. Then you pay. How much is the payment? 50. Good. You paid 50. So how much will be the balance due? 89,778. Then you pay the interest based on the balance due. Yes. 33. So you take the balance due. You add the interest accrued for the period to get the balance carried down. 96. 511. The balance carried down becomes the opening balance. 96, 511. Then you pay. And the payment is 50. So the balance will be 46. 511. 7.5% of that. That's for 88. So you take the balance due. You add the interest accrued for the period. You get 50,000. The balance carried down becomes the opening balance. 50,000. Then you pay. How much are you paying? 50. How much will be the balance due? How much will be the interest? Good. So how do we now show that in the financial statement? So income statement extract. So here we have 2018, 2019, 2021. Show expenses. And we have two expenses. One is the interest expense, and then we have depreciation. We have the interest 97.52. We have 67.33. Then we have 34.88 cash. Depreciation per annum was an amount of 45.107. 45.107. Then statement of financial position. So you have an asset here. You have the right of use asset. Now, the right of use asset was an amount of 180,428. Then you deduct the depreciation to an amount of 45,107. So how much would be the balance current? I mean the net book value? 135? 329. 321. Then you just depreciation for the second year, you minus 45, you get 90. 214, eh? Then you just 45,107. Good. Then we have liability. For the liability, we have non-current liability. We have a lease obligation. Also, we have a current liability. We have a lease obligation. Now, whenever you're paying in arrears, we see that for the non-current liability, you take the balance carried down. For the current liability, you see that you take what? The principal. Now, when you're paying in advance, there is obligation for the non-current liability, you'll take the balance due. Then for the current liability, you'll take the payments. Take the payments. So for 2018, you take for 2019. So you'll take now, you're dealing with the balance due and the payment. So for 2018, you take for 2019, you have an amount of 89,778. You have 46,511 dash dash. Then for the current liability, you take the payment. Yeah, what you expect to pay within the next one financial year. So you have 50, 50, 50. What's that? So you can copy now. And that marks the end of that topic. IFRS 16.